right, Fook Hien is Senior Investment Strategist at Standard Chartered. He's joining us. Fook, great to have you with us here. Thanks very much. So should we expect a meaningful change from the Fed tonight? And what would stand out for the markets?
Yeah, I think our expectation is that pretty much with what the consensus is saying that it'll be a pause. Our expectation is that for this year, we're looking for about 5 rate cuts or 125 basis points. But most of that is going to be loaded in the second half of the year. In terms of what we're going to watch out for in the Fed, anything he says about the timing or the magnitude of the rate cuts is going to be very critical. I think March, at the moment, the probability is less than 50%. But if he says anything to the effect that still keeps March alive, then that could be something that's interesting. We still have 4 significant data points, I think, before the March meeting, 2 employment reports and 2 inflation prints. So that's still something to watch. And also, this back to the market at the moment, pricing in 5 cuts for the year compared to the dot plot from the Fed back in December, showing 3. So there's a bit of divergence here. Again, how much will he push back? I think the market pretty much sees a 3 as a minimum kind of rate cut that we'll be seeing this year. But if he says anything to the effect of pushing back against that or pushing hard against expectation for 5 rate cuts, I think that'll be significant in terms of what to watch from the Fed and Chair Powell today.
Oh, so you're saying that there won't be any rate cuts today, but any indication of how many rate cuts could come through is something that could perhaps affect the market's mood. Got it. How are you positioned in a market like India? We have a big event upon us, the union budget. Do you have any expectations from an international investor standpoint? And in general, what's your view on India?
Yeah, we do like India in the long and medium term. We've got it as a core holding for investors. But, we looked at the one of the trackers we look at is the technical indicator for investor diversity of fractals. And it's showing that it's actually a bit stretched in terms of investor positioning for global equities and for India as well, and for US equities and a few other sectors. So, in our latest weekly report, we've been advising investors to trim a little bit of the equity holdings. They've done well year to date, and we're still overweight on a 6 to 12-month view. But in the very short term, just technically, there's concerns whether it has gone too far and too fast. And if we look at this diversity indicator, it shows a bit of a crowded positioning. So we are thinking that there could be a chance of a pullback. It will make sense that the investors who have benefited and fully invested, that they would trim some of their holdings and still be able to maintain exposure over the next 6 to 12 months, as we do still like global equities for 6 to 12 months.
All right, folks. So if not India, then where? I think in the past you've spoken about the Korean markets that you liked, and I think some of those developed markets as well was something that you were favoring. I think US as well as the Japanese index. If that continues to remain your preference?
Yeah, no change there. No change there. We still like the US. We like Japan, and within Asia, you're right. Yeah, we like Korea as well. Obviously, US very much, earnings is a big focus at the moment. In Japan, we think we saw the tax reforms in Japan in terms of the incentives for local to invest in a tax-free manner. They increased that allowance, and I think that has attracted some domestic flows. So that's positive for Japan. And internationally, we think the corporate governance improvements will continue to improve that as well. And in Korea, I think we still expect the semiconductor cycle bottom to be behind us. That'll be beneficial for Korea's stock market. There's mixed news out there as the companies are reporting as to the timing of this cycle, whether it's too soon or not too soon. But we do think that over 6 to 12 months, Korea can benefit, as we do expect 2024 to be a year of rebound for Korean earnings.
Okay, all right. We will leave it at that. Thanks a lot, Fook, for joining in and giving us your quick view. That's the word on the global markets and how you should approach big events. But